Hello and happy Wednesday, June 24th. Welcome to another edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going over to the markets today, coronavirus fears turned the markets down. All three of them ended in the red, all with 2% or greater losses as of today. So we did see that impacting the crude oil pretty substantially. The futures there dropped down to $37 barrel range on the futures. And subsequently, flight to safety, U.S. 10-year Treasury yields moved down. More buyers of those bonds caused the yields to move down because prices and yields move inversely to each other. So we are seeing about a 4 basis point shave off on the U.S. 10-year today, 68 basis points. Since it happened pretty quick today, I didn't see any carryover yet into the multifamily markets. I'll get an update on the agency desk tomorrow on that. I expect FHA rates, we may see a change later this week. It might be until next week. Remember, I've said in previous episodes, rates do move up much faster than they move down. So when the Treasury drops, we might not see that immediate tightening that we would hope to see on the lending rates eventually. Speaking of that, jumping over to FHA multifamily, 223F staying flat today at 245 mid-range, fixed for 35 years. And the 221 D4 is also flat again at 310, that is fixed for 40 years. Going over to agency, Fannie Mae DUS flat at 290 for 10 years. Freddie Mac still quoting at 306, that is also fixed for 10 years. Again, I expect some updates. I expect the GSEs to move faster and be more responsive to the drop in the treasuries. We'll see about that tomorrow. Remember, they do have a floor, so they're not as reactive as they once were. But let's see what those look like tomorrow. And again, FHA, we'll keep an eye on that. What I want to speak with you about today and other news, a couple things. One, I spoke with a banker, a commercial banker that is processing a loan application for an office building refinance. And the reason I want to mention that to you is it's an encouraging sign that even in one of the asset classes that we all, hear about the most, I guess that and retail probably are equally the most troubled as far as futures, there are still opportunities for lenders, conservative banks, to make loans to strong borrowers, just like they always have, frankly. So I want to bring that up in the context of this experience we're having with this market this year is not akin to the Great Recession. The Great Recession, for those of us who lived with it, really was a pencils down, lenders stopped lending, and it created a big problem in capital markets. Okay, we're not seeing that today. I mean, we really are not. Lenders are lending, borrowers are moving forward and being funded, and to some extent, it's business as usual in the capital markets for the debt side, okay? So I think that's an encouraging thing to hear. When I heard about that office building, I thought, wow, that's great. It's a single tenant, it's an anchor tenant, so there's even more risk in it, but great to hear that. Then I spoke to a developer in Texas who's moving forward and got a commitment on an FHA 221 D4, supposedly one of the lowest rates of that program. I believe it. I've been talking about the lowest rates in history here that I've locked for clients, so I don't doubt they've got maybe one of the lowest rates ever on a 221 D4, doing an affordable housing project with low-income housing tax credits, also known as LIHTC. Again, people are moving forward. You hear in the market the tax credit pricing is just not good, and there's all these sort of hubbub we hear in the marketplace about things being stalled or not moving forward. I just want to say that it's not true. It's not what I'm seeing in the marketplace. I talk to lenders and borrowers every day, and I talk to lenders across all different kinds of platforms, and people are lending. Bridge lenders are lending, banks are lending, GSEs, FHA are lending. So here's my thought of the day for you developers and owners of multifamily assets. We're getting into the back half of the year, right? This is the back 9 of 2020. We're already almost closing up here June. So what can you focus on in the back half of 2020 that is going to have the greatest positive impact on your business that you are not focusing on right now? Okay, that's what I want you to think about. Just take that one away and think about what is it that you could do that would impact your business that you're just not focusing on right now because you've been too busy with other things. Okay, focus on those fundamentals and pretend for a second that it's just a normal marketplace if you can when it comes to debt and when it comes to moving forward on your business plan. Because I'm seeing others do it very successfully, and I feel those are the companies that coming out of this are really going to be better positioned to take advantage of what they were able to do during these times in particular. So I know it's difficult at times. I certainly have a million things going on. It's hard to focus on those key things that matter. Maybe just come up with 2 or 3, write them down, and focus on them on the back half of this year. And I think you'll see that there'll be a real positive result for your business plan coming out of that. That's my thought of the day. Thank you for tuning in to another exciting edition of Rate Desk. I'm your host, Michael Thomas, signing off.